Good morning, everybody, and welcome to the Siler Wealth Management video blog. Today is Tuesday, April 5th, 2016, and I just have to say a few things because I'm a little bit, whoever you're voting for, I'm really sick of this presidential election, like many of us are, okay? It's turned into an absolute joke. The GOP's a joke. The Democratic side's a joke. So, whoever you vote for, this is not something like, I'm not slamming a candidate because I really don't care who you vote for. That's your own personal preference, and mine too. And however, what I don't like is that when a candidate comes out and tries to use a fear tactic to gain votes, one fear tactic is that we are due for a massive recession. This country's due for a massive, that's the term, massive recession. And then when asked, well, what if you're president? Oh, then we won't have a massive recession. Look, I think that's ridiculous. I think that's something you shouldn't be saying. I think that's, I don't believe anybody can prevent a massive recession. You have a president can't all of a sudden make policy changes that will deter a massive recession. It takes time. It takes the Fed. It takes Congress, all that red tape. My point is, there are a lot of things going on around us, and most of it sounds really, really negative, all right? Because every presidential candidate, especially on the GOP side, is telling you how bad things are. And the Democrats are going to tell you how bad things will be if the GOP comes in. So we're already surrounded by negativity, all right? And the market has made a big move in March. And here's what happens with big moves. Big moves have to be digested. So stocks, markets, indices, they don't go just straight up. There is a backing and filling process. Certainly, the market has made a big move. After a big downward move, January, February, it went straight down and then has bounced up for part of that move downward, almost all of that move downward. So we are certainly due for a pullback. There's no doubt about it. We've done some selling. In fact, we sold our entire position in Facebook yesterday at a very, very large profit. And let me tell you why. Stock started trading, it's been really trading well. And then we see yesterday, big volume to the downside, down a little bit. And then there's circulating out there, there's some talk that they may miss their quarter. So Facebook is a stock that is priced to perfection, meaning it trades at a very, very high multiple, so it better be on target. In fact, it better do better than on target for it to maintain that valuation. Facebook's a rich valuation, no doubt about it. Great service, billion users every day. However, if they just one little hiccup, the stock could drop to 100 again. I mean, it was just because we bought it at 80 not that long ago, and we sold it yesterday at 113.79 plus or minus a little bit. So we had a really, really good gain. And what our thought is when I manage money, like I do, I manage money for a living. I'm thinking, okay, we've had a big run from 80 to 115. Now it's pulled back a little bit, big volume. Why get greedy? You take your profits. Sometimes, hey, you're in the market to take profits. My point I'm trying to make is don't let people scare you out of the market. Let the stocks or let your individual investments dictate to you. If they're not performing well, then at that point, you get rid of them. A couple of things you can do. We have what I call a strategy called the prevent defense. And right now, my prevent defense basically has everything on an 8% leash. So what that means is if you're in something I hold, XYZ, or a fund, it doesn't matter what it is, if it drops 8%, we're out. That's what we're doing right now. We instituted that only because we don't want things to drop 20, 30% and we're still holding on, okay? A lot of the fixed income stuff, especially the things that are not correlated, and I keep talking about assets that are not correlated to the stock market. You can get some really good returns and the investment not care what the market does. That's part of the endowment type philosophy, meaning Yale, Harvard, Princeton, Stanford, they invest a lot of money in the investment universe. I'm not saying all the market, and 40% of their investments are non-correlated assets, meaning they don't care what the market does, but they're cash cows and driving it in. We talked about apartments. I talked about managed futures. We're doing that kind of stuff for clients. So that's kind of the thing we're doing. Now, however, there was a little bit of good news here. Let's see. Credit Suisse. Credit Suisse yesterday raised their price target on Apple to $150 a share. Apple closed yesterday at 111.12, indicating a little bit lower today because the market is going down. But, Apple did hit that 130 last year. It pulled back to the 90s, and great opportunity. We bought some more, and we own a lot. We own Apple as low as the 40s. So, we don't care. I think Apple's going to be a longer-term hold, and I don't plan on selling that anytime soon, although you never know. But Credit Suisse raised their target of Apple to 150. It's just ironic because 2-3 months ago, everybody hated Apple. And they said it could never get out of its own way, blah, blah, blah. The iPhone's dead, Samsung, now you put an iPhone, you drop it. And now I love the commercial. You take your phone, you drop it in the water, and you can still talk on it. That's phenomenal technology. I'm not knocking it. My point is, you look at valuations. Apple, and this is not a buy recommendation for Apple here because I wouldn't buy it at these levels. We own it much cheaper. But my point is, you are trading at a valuation at a significant discount to the overall stock market. So it's really a great value situation. It pays a dividend. I think it's a good stock. You have downside. Everything has downside right now. So that being said, right now you got to be playing a little bit cautious in the markets. We are indicating a little bit lower opening, about 100 points. Markets overseas had a little bit of a struggle. Oil has made that big run. Now it's pulling back a little bit. So all of those external forces are driving us lower, especially the international markets. So that being said, just be a little careful. Don't go out there and make any major commitments on buy side in the market stuff. Look for non-correlated assets. We have a laundry list of non-correlated assets that we believe will get our clients a phenomenal return because I think the market is going into a lower return environment. Based on history, the market's done 9-10% forever based on history. I think it's going to be a little bit lower than that. I think this year, and I said this when the market was at a low in February, I said from this point, meaning 10% ago, I thought the market would close higher than where it was. At this point, I think we could go a little higher, but I think we could go lower first. So we may hit a new high via a little bit of a pullback, and I do not see a bear market coming. So please, just the talking heads, remember what analysts' jobs are. An analyst's job is to create transactions. So when you hear that Credit Suisse, good example. We think Apple is a $150 stock. That's our price target. What are they doing? They're creating their brokers to go out there. Hey, let's buy Apple. It's going to 150. Our analyst says this. Same thing on the sell side. Mohammed El-Arian, who is a big-time analyst, I think he's at PIMCO or one of those big firms, he said not one person can prevent a massive recession. And I totally believe that. But the talking heads are exactly what they are. They're wrong as much as they're right. The key is you got to be right a little bit more than you're wrong, and that's what we're trying to do here. Also, a couple other things. It is April 5th. We have a lot of people coming in the office to do IRAs and make their contributions before. It's April 18th this year, but please, please, please do not come in on April 18th thinking you're going to get a tax deduction for making an IRA contribution. Not going to happen. Let's try and make it cut off somewhere 12th to 13th. I mean, if you have to get in on the 15th, we will get it done, hopefully. But on the 18th, it's not going to happen. So you can contribute to your IRAs, $6,500 if you're 50 or older. If you are under 50, 49 or younger, it's $5,500. Okay, for us older folks, we can put $6,500 in. It's been a pleasure bringing you today my Silent Wealth Management video blog. StockDoctor.com. That's my website, StockDR.com. It's going to be hitting the digital presses any day now. It is approved. We are just waiting to turn the switch, and it'll be on. A ton of resources there. And continue to share my video. I really appreciate it. You guys are liking it. You're sharing it. A lot of people are getting great information. I'll let you know when our next event is. And if you share my video, you can be entered for a drawing for a cruise for two, which I'm running out. I'm almost done, and that promotion is going to be over. It was huge, though. Huge. So please share my video, and I'll put you in for the cruise for two to the Bahamas from West Palm Beach. Everybody have a fantastic day. Give us contact if you have any questions.